Market news now. Global stocks rose, lifted by a rally in Asia after China pledged to step up support for its economy, while evidence of a slowdown in European growth dented the euro. China's top leaders pledged to step up help for the economy, which is struggling to sustain a post-COVID recovery, and signaled there would be more to come for the property industry. Meanwhile, Kumba Iron Ore reported a 17% decline in half-year profit due to softer iron ore prices and persistent rail logistics problems. The miner believes that collaboration between private investors and government could help resolve mounting rail bottlenecks, which are forcing it to stockpile more iron ore at its mines. The iron ore producer declared an interim dividend of 22.60 per share. To give us more perspective on the markets, we are joined by Makwe Masilela from Makwe Fund Managers. Makwe, thank you so much for your time this afternoon. It's quite interesting to gauge the perspectives of different analysts when you ask them about market sentiment, especially over the past few weeks. But how are you looking at market sentiment right now versus a few months ago?
You know, we've realized that the markets so far have managed to go up. Sentiments have managed to change as people start to think that we will probably get more of a soft landing, even though some of the data continue to show that the risks are still there when it comes to recession. But markets generally think that, listen, the economy is strong enough to be able to resist these high interest rates and at least manage a soft landing. And yes, with the numbers from China, which were disappointing, and the Chinese authorities now also forced to come with some policy measures to stimulate the economy. That also tells you that, yes, economies can at least be helped out of the situation. The problem here is the rally that we've been seeing, the breadth thereof has been very weak. So that is a concern. And usually that's indicative of a bubble. So I think we have to tread cautiously, even though we still see that the stocks are still going up.
I mentioned in my intro that we had Kumba Iron Ore releasing their half-year numbers, reporting a fall in profit, but also those stockpiling issues seem to be plaguing them on the back of the rail bottlenecks. What was your key takeaway when you look at those results?
I think most of those bad news are already been baked into the asset price after we got that trading statement. Remember, they even told us that they will stop almost 2 billion of non-core capital expenditure. But yes, look at China itself. We've seen that the slow pace of the economy resulted in demand being low. We've seen that even outside China, that the demand has been low because the global economy has not been growing that great. Fortunately, prices have been supported in the fact that we've seen that when you look at the stockpiles at China's mills, they're almost at a 5-year low. So that is giving a tight balance when it comes to supply. And hence the likes of Kumba could manage a freight on board of almost the price thereof of 4% above the average benchmark. And yes, production up nearly 6%, but you look into their profits as headline earnings per share down 17%. Hence, it's not surprising for them to cut their dividends by almost 21%.
So with the share price reacting at up 5.8%, what's the market's perception of these numbers? Are these, I suppose, are they seeing the future that perhaps Kumba Iron Ore could navigate some of these challenges?
Definitely. Remember that the results are backward looking, but also Kumba is up at the back of other commodities. We've seen that other miners are doing well, and all these miners have been lifted by the announcement yesterday that China signaled that they'll do more to try to lift the economy. And we know that they're a major consumer when it comes to those commodities. So Kumba is also benefiting from that, just like other miners. And it's not only back home here, even in Europe, you can see that the miners are up.
Speaking of commodities, you're looking at Brent here, and I found it quite interesting that it managed to settle above the 200-day moving average. I mean, how important is this?
Very important for the oil producers, not for us consumers, because now it makes our life difficult. As we know, that's inflationary. We're a net importer of oil, but all because of the expected supply cuts. Remember, the likes of Saudi Arabia and Russia announced that August they will continue to cut supply, and as well, the fact that China is trying to stimulate the economy, it tells you that there's a possibility of demand. So in a situation where there's less supply and there's a little bit of decent demand, definitely that will benefit oil prices. Hence, we still see them at elevated levels.
Earnings season stateside, I mean, we've just been about a couple of weeks into it or so. What are we learning so far from the numbers that have been put forward?
So far, the numbers have been very impressive, and we expect that to continue. Even today, when you get the likes of Microsoft, Alphabet releasing the results, that will continue to help. But remember, the stock rally that we've been seeing, especially in the US, have mainly been driven by the Magnificent Seven. That is mainly those IT stocks, including the likes of Tesla. So if good numbers continue, then definitely we'll continue to see the likes of Nasdaq going up, and hopefully that will spread over to other sectors as well.
What parts of the market have lagged so far this year that you believe have the potential to go up?
I think locally it has been more of our shop retailers. Look, the likes of ShopRite have just been up in 6% year to date. The likes of Pick and Pay down almost 33%. The likes of Spar almost down 11%. And here you are talking about in an environment where more than 50% of your people spend more than 60% of their money on food. So I guess they should have managed to benefit. And I think with interest rates being paused, that probably will help going forward. That we will start to see some nice uptick when it comes to our food retailers.
Before I let you go, just quickly, when you look at those recession fears and the inverted yield curve, how are you reconciling the two?
I think at some point it has to come to reality. The inverted yield curve have to be off in the fact that we don't expect interest rates to go up, and especially after tomorrow that we expect the US to hike rates and thereafter pause. So we should start seeing the yields going down, because yields usually go up at the back of the expectation that interest rates will continue to go up. So if we start to realize that interest rates won't be going up and that press conference of the US Fed will be critical, then definitely we'll start to see the yields going down.
Makwe, thank you so much for your time this afternoon. That is Makwe Masilela from Makwe Fund Managers.